Good morning, everyone, and welcome to Virtual NLA. I hope you've seen in our newsletters now that we have converted almost all of our program now to digital means of communication. And one of the benefits of that is we can get many more people to our events than we're able to in Store Street. So welcome to you all this morning when we're going to hear from industry leaders about the impact that COVID-19 is having on London's development sector at the moment. Some of you may remember that in January this year, we held a State of the Market seminar that looked at what to expect in the year ahead. And then we had a new government that was just settling in. We're expecting to have a London mayoral election in May. And the main uncertainties concern the impact of Brexit and its effects on the built environment sector. But obviously COVID-19 has changed all that quite dramatically. The economy has been affected in unprecedented ways. So I'm looking forward to hearing what our expert have to say today to give us some feeling of what might happen over the next couple of months. So we're going to start with a presentation from Nick Rowe, who's a partner at Gardner and Theobald, and that'll be followed by responses from our other speakers. And we've got a Q&A following that. So please do put your questions onto the Q&A pad that you have on your screens. And we'll deal with them once the presentations have been finished. So I'd like to start by inviting Nick to talk about the impact on construction sites and the supply chain and the development pipeline. Nick.
Thank you, Peter, and good morning, everyone. If we can put the first slide up, please. Thank you. The update I'm about to run through is Gardner and Theobald's latest summary of the current market conditions we are seeing in the light of COVID-19 pandemic. It's a snapshot of a market that changes on almost a daily basis. The areas I'm going to touch on are construction sites, the supply chain, pipeline, and tendering. So if we can go on to the construction sites slide, please. It's recognised by both government and the industry alike that keeping construction sites operational is critical to the UK economy. 61% of projects on site remain open as of today. But this is playing out differently in parts of the UK, with Scotland and Northern Ireland having more extensive shutdowns than England and Wales, imposed by their devolved administrations. The Construction Leadership Council is working with government on behalf of the whole industry to continue talks about how we can kickstart the economy through construction and extend site opening hours in the near future. The industry has become somewhat buoyed by the government's commitment to HS2. CLC published new site operating procedures to support continuing activity on construction sites, and these are now on force. The procedures give detailed advice about how to keep workers safe while at work. We are now on SOP version 3, which was published on the 15th of April. Site operating procedures, which require a 2-metre distance to be maintained between workers where possible, will hamper productivity for as long as it's in force. There will be some innovative and creative changes to working procedures, and this will help with productivity, but it will take time. In the short term, lower productivity will manifest itself in programmes and tenders. Almost all contractors have furloughed a portion of their workforce. As more sites open, will it be difficult to get these workers back on site? Fewer operatives numbers will mean lower output and higher costs. However, countering this, a reduced on-site workforce may make recruiting skilled labour a little easier and push down wages. House builders such as Taylor Wimpey plan to restart works on sites, but say it could take until at least June to reach 80% of normal activity. Full capacity isn't expected to return until 2021. Contractors, such as Mace, appear to be working to a similar timeline. For some, on-site productivity is currently only 10 to 15% of pre-COVID-19 levels, but many plan to ramp this up to over 50% in the coming weeks. Supply chain, if we can go on a slide. Whilst the recovery in demand is expected to be U-shaped, some forecasters suggest that supply could be L-shaped. At the moment, many manufacturers have reduced production capacity, but are still actively supplying projects. To return to full capacity, they will need to be confident that sufficient demand has returned and is sustainable. Otherwise, they run the risk of having to stockpile unsold products and cut their workforce. Contractors are concerned that sites will be unable to restart because trade contractors and materials will not be there. Some anticipate that cash-strapped suppliers will start to struggle in the coming weeks, and so contractors are considering whether they can prop them up or buy stakes in such firms in order to keep them afloat and prevent potential collapse. The Builders Merchants Federation was a co-signatory of the Construction Leadership Council letter to the Prime Minister earlier this month, requesting clear and visible encouragement and support for the production of building materials to continue. The BMF issued new branch operating guidelines on the 20th of April for staff in England and Northern Ireland. Again, there is a separate regulation in Scotland and Wales. The guidelines stress key messages. 2 meters social distancing must be observed at all times between staff, customers and suppliers, and cleaning routines must be laid out in detail, and their compliance is mandatory to avoid transmission of the virus. The guidelines are put together in collaboration with the Construction Leadership Council with input from firms including Travis Perkins, the UK's largest builders merchant, Wates, Bradford, Kellaway, amongst others. You can go on to pipeline. Although work has stopped at 29% of all UK construction sites, accounting for 64% of the value of work currently under construction, Glenigan reported a significant increase in detailed UK planning approvals in March compared to any of the previous 12 months. This is positive for the long-term project pipeline, but the short-term project pipeline is faring less well. Data from Barbour ABI shows that contract awards in March were weak, falling to 3.8 billion from 7.6 billion in February. Furthermore, many of the contracts awarded in March have now been put on hold. However, in the first quarter of the year, the total value of contract awards were 26% higher than the previous quarter and 17% higher than Q1 2019. Before the pandemic hit the UK, we were clearly experiencing improving demand conditions in the wake of the general election result and a positive March 2020 budget. Lockdown restrictions have certainly had an immediate and severe impact on projects currently on site, as we have discussed, but the long-term development pipeline looks to be holding steady. The current uncertainty has inevitably led to a fall in new inquiries, which will hit the project pipeline in the short term, but projects at the design stage are proceeding. Most work in pre-construction also appears to be proceeding as planned, but is often pausing or stopping at the end of a design phase. Tendering. We can move on a slide, please. We do expect that without agreed terms and conditions and specific COVID-19 clauses, contractors will either price in greater risk and uncertainty into their tenders or exclude all risks associated with the coronavirus pandemic. We are seeing some discounting on tender packages for fit-out trades in the region of 1 to 5%, but as yet, none of these trades have agreed terms and conditions. Tender pricing is likely to remain fairly level as inflationary and deflationary pressures are cancelling each other out at the moment. Inflationary measures we are seeing include reduced on-site productivity due to site operating procedures, which will see preliminary costs rise as sites adjust to the additional burdens imposed by social distancing for their site workers. Labour sourcing constraints, as mentioned earlier, could push up the cost of labour. Constrained imports and the need for alternative material sourcing could mean potentially higher costs. And insolvencies, lowering industry capacity and reducing tendering competition. Offsetting these pressures are the deflationary effects of depressed raw commodity prices such as oil and metals, lower demand for products and materials while sites remain closed, fewer new orders and therefore increased competition and downward pressure on contractor margins, economic depression in the wider economy and reducing wages and salaries. So how will the construction emerge from the crisis? If we can move on a slide. Will the recovery from COVID-19 be short or long? No one knows at this stage. Will we see reduced demand and confidence for construction projects? And if so, how many businesses will fail along the way and how much talent will leave the industry? Some things we are likely to see are COVID-19 no longer being a force majeure item, a standard pandemic clause being introduced into construction contracts, and professionals qualifying their advice in the light of ongoing social distancing and working restrictions. But we believe the key to recovery is supply chain resilience. If manufacturing and production output remains persistently low, then it will take longer for contractors to return to site out of fear of not being able to secure materials. Equally, builders merchants will need to feel confidence that sufficient demand has returned in order for them to ramp up capacity. Otherwise, they run the risk of having to stockpile unused materials and products at significant cost. The length of recovery phase will also depend on how quickly workers can be unfurloughed and brought back to continue work on site. Innovation and new thinking will undoubtedly come from the crisis. Methodologies will be developing for measuring productivity impacts and mitigating them. We could see greater productivity from changed ways of working on sites and in offices. Greater investment in and use of modern methods of construction to reduce construction time and cost. And perhaps, most importantly, greater collaboration across our industry, which has been notoriously fractured and disconnected. Thank you.
Thank you very much, Nick. And now our next speaker is Alex Yan. He's the Chief Economist at Arup. Alex, over to you.
Thanks, Peter. Good morning, everybody. I think I've been asked to talk a little bit about what COVID-19 means for London's economy and the path for recovery, and how this will affect the sector that we've just heard about. And I think that it's worth saying at this stage, we've seen this in the sorts of variation and the changes that have been going on in the economic forecasts coming out of some of the big finance houses, that there's a very significant degree of uncertainty, as always, in predicting the future. And that in that sense, it's probably more prudential and perhaps productive to think of this, what might happen in terms of a few scenarios that we can then pick and choose from as the information, the pieces in the recovery puzzle, if you will, sort of come together. I mean, thinking about London and central London in particular, it's probably worth rehearsing a couple of facts. One is that central London's economy, so that's the central activity zone, plus the Isle of Dogs, where Canary Wharf, of course, is, now employs something like 1.9 million people on a full-time equivalent basis. And together, they generate about 200 billion of output, which is around 11% of the total for the UK. And of course, alongside that comes a big contribution to public coffers in terms of taxes, which have been used historically largely to fund public services outside of the capital. Now, normally, I think we would probably be in a position where we have normal recessions, or we've had previous crises of sorts. We can talk about 2008 from either perspective, but we'd normally expect central London to be very resilient to shocks and to be able to come out of these sorts of occurrences ahead of the pack. And indeed, that might still happen. The reason I'm slightly hesitant today is because the thing that gives central London admirable qualities from a planning and a sustainability perspective, i.e. its high dependency on density and indeed the use of public transport in order to get people into work, now looks like an Achilles heel for its economy, depending on the policy of social distancing which is going to be employed. And I do think that social distancing and attitudes towards social distancing is going to be key to understanding the medium-term economic impacts of the virus on the central London economy. And the reason I say that is because, as I say, this high dependency on public transport, which Johns Hopkins University has identified as a key factor in how areas are able to have been coping and dealing with the transmission of the disease, and indeed the extent to which it's a precursor for transmission. And the fact that if you take any attempt to place social distancing measures into our real estate or indeed into our public transport system, in both cases you see a big reduction in the capacity of the system to be able to accommodate employment. So I think that, combined with public attitudes to how comfortable people feel about being on public transport, combined to the extent to which this crisis has accelerated trends that were already in the system. So, for example, a reduction in commuting, which was already locked into the system in overall terms. Rail has been taking a bigger share of a declining market in commuting in the UK. And then, structural changes in the labour market around the gig economy, more part-time working and so forth. Those factors together, I think, may create a scenario where the central London commercial real estate market is going to see a very difficult period. Now, in terms of responses to that, there are clearly a number of ways to go. And we've already heard a little bit about from Nick around, for example, the extent to which deregulation might be one way of bolstering some of the sectors in the economy which we know are going to be struggling. So not only could you have longer hours on construction sites, which I'm sure residents in central London will be delighted to hear about, but you could also see a relaxation of hours for pubs and restaurants in order for them, and indeed theatres, to allow them to put more people through in any one day. But having said that, I do think that these changes are potentially formidable. They're very, very challenging in many ways. And as I say, in one world, you can see an expansion of public transport services to provide more capacity to allow for more distancing. Boston's system is looking at actually increasing frequencies to deal with the problem. Whereas the other option is, of course, is to have a much more rationed system, which you could do through pricing, which I'm sure would be very popular. So Peter Hendy's talked about bringing in compulsory reservations on intercity trains, which would, of course, deal with overcrowding, something which actually is the de rigueur in the rest of Europe. And indeed, in terms of real estate, you could imagine a world in which a lot more real estate is provided in order to provide that reduction in density, which, of course, until now has been the hallmark of the way in which the industry is going. So, for example, the work we've done with the London Property Alliance shows that over the last 20 years, the average worker in central London has seen a 20% reduction in the amount of floor space allocated to them. And I just think, and I'm sure we'll come on to discuss this, that the business models which have been around packing more people in to smaller spaces, the shared workspace type model, amongst others, are going to be under pressure. And there are kind of, as I say, there are two ways to go. We can either try and increase capacity in the system, whether it's on public transport or in terms of real estate in the centre, or we can try and ration it. And I know that Tony will no doubt pick up on this, but there are other options, depending on how long these trends are going to remain in place for, as to whether or not we should think about a more distributed growth model. So should we move to a more polycentric view of London, where we don't bring everybody into the centre? That would be one idea. Or should we see more dramatic changes in working hours? So where we have off-peak capacity on the system, particularly in the outer zones, should we be trying to choreograph workers to come in and use the system during all those times? So there's a lot of sort of debate, I think, around that. The only thing I would say is, I think at this stage, we don't really understand how any of those changes might impact on the benefits from agglomeration that London and other world cities, such as New York, use to their competitive advantage. So what I mean by that is, we understand reasonably well now that bringing lots of people into the centre of a city to work is good for employers and it's good for employees because of the depth and breadth that it creates in the labour market, both in terms of individual sector skills and indeed the number of skills that employers can tap into and the spillover effects and so forth. I don't think any of us really understand the extent to which any dilution of that model through the use of technology or a degree of dispersion will actually reduce the competitive advantage of cities such as London over other areas. I mean, what I would finally say is that we have now ended up in a sort of topsy-turvy environment where cities and places with high levels of car dependency and low levels of density at the moment arguably have a competitive edge on cities such as London and New York, which, as I say, have, for lots of good reasons, prided themselves on high density and high public transport use.
Thank you very much, Alex. Lots of points there for the discussion. We're beginning to get a few questions already, so do keep them coming. Our next speaker is Digby Flower. He's Chair of UK and Ireland at Cushman and Wakefield. Digby.
Thank you, Peter. Good morning. I've been asked to talk this morning about how COVID-19 is impacting the occupational and investment markets in London, and to look at that now and in the short and the medium term. It's fair to say the occupational market is actually enduring the lockdown better than we'd anticipated. Whilst a significant number of smaller transactions have been aborted, and the serviced office sector is undoubtedly suffering with very little new demand, larger transactions, and particularly pre-let transactions, are continuing, and we haven't seen much let up in that. There are, at the 1st of March, there were 44 transactions over 15,000 feet under offer in the London market, and another 3 have gone under offer since. But if you analyse those, 11% have completed. So Covington and Burling, major US law firm, committed to 86,000 feet in 22 Bishopsgate last week. Queen Mary University took 54,000 feet in Department W in Aldgate, and CDW, also in the city, took 29,000 feet at one New Change. All deals in the last 10 days. The further analysis is that 77% of the remaining deals are still progressing, and actively so, and only 6% of the bigger deals have been aborted. The reason for this, and I talked about this back in January, is that the vacancy rate across London is at historically low levels, currently about 4.87%, and particularly significantly, 67% of stock under construction for delivery in 2020 is pre-let, and 52% of stock for delivery in 2021. What that means is that large occupiers with lease events in the next 3 or 4 years realise they have comparatively little choice. And going back to what Nick Rowe was saying, that choice is not going to increase dramatically over that period with the issues in construction. And therefore, they need to secure stock that's in the pipeline to future-proof themselves. Turning to the investment market, the most common question asked by investors over the last 6 weeks has been, how far have prices fallen? The honest answer is that in contrast to the occupational market, we're suffering a dramatic fall in transaction volumes in the investment market, and there's very little evidence of pricing. Over the 12 quarters since Q1 2017, we had a healthy investment market, average volumes of £4.25 billion a quarter, £4.25 billion a quarter. Q1 2020, that fell to 2.1 billion. Q2 2020, we anticipate that halving again to 1 billion. And the other significant thing about that is in the GFC, it took 6 to 9 months to get to that place. This time, it's taken 6 weeks to have that very significant fall in the number of transactions in the market. The reasons behind that are principally a lack of stock, with vendors waiting to see how the market evolves. It's also a product of vendors being distracted by managing their existing portfolios. And the very significant point here is rent collection. And at Q1, and you may well have seen the stats, collection of rents fell to 40% in some retail portfolios, whilst the office portfolios fared better at 70 to 90%. This is partly the unintended consequence of government suspending landlords' rights to forfeiture for non-payment of rent, and more recently, indeed, suspending the right of landlords to issue statutory demands. Whilst that was designed to protect the vulnerable, it's actually an unintended consequence has been that a number of very major household names have cynically not paid their rent, despite being fully able to do so. That's not actually helping the landlords to look after those in need. This issue is being addressed with government by the BPF and is critical, because we're now in a position where, of course, property owners still have to pay their interest on their debt, and of course pension funds still need to pay pensions, but that becomes increasingly difficult for them to do if they're not receiving rent, and indeed in the case of the pension funds, of course, there's been a major suspension of dividend payments on equities as well. The big question, therefore, for the investment market is what will happen at the June quarter day. One can only have a healthy investment market if you've got secure and demonstrable cash flows. So we have to trust that the government will have addressed this before we get to the June quarter. So that is time critical. So what about the future? The future, and Alex touched on this, is about the return to work, or the immediate future, the short-term future. And in brief, this is going to entail a combination of office working with social distancing and continued remote working. Achieving social distancing in the workplace will mean occupational densities of 50% of what they were, i.e. with half of desks being unused. And going to what Alex was talking about, given the dependency on public transport in London, getting to work will be the first major challenge. It's likely that it will entail the possibility of wearing masks. It's likely it will entail staggered working hours and split working patterns. For example, some working Monday, Wednesday, Friday, others working Tuesday and Thursday. It may also result in 7-day operation. Once at the office, there will be a need for demarcation of circulation routes, including lifts, stairs, desking, meeting areas. Have a look on our website at the6footoffice.com. This is something we've done in our Amsterdam office to demonstrate how actually these circulation routes can work and how you can actually operate with 6 feet of social distancing. From an FM perspective, there'll also be new protocols for cleaning, reception, PPE, food provision, air conditioning. And to another point that Alex talked on, all of that will only be achieved by very careful briefing of staff before they come back into the workplace. Having emotionally kept people at home, we then have to break that emotional hold. And actually that's going to be more difficult to do than people might think. If you've taken the trouble to stay locked down for the last 6 weeks, you're not going to walk back into a dangerous environment without being sure that you're going to be protected. And I think there's quite an issue there. Look on our website, sorry, second plug for Cushman & Wakefield this morning, because we have released our back to work manuals on our site, there is actually a 30-page manual about telling you how to get back into readiness for work for both occupiers and landlords. That draws on our experience in Hong Kong and China, where we've already been through that process. Finally, just to talk about the medium term, and that's going to result in a fresh look at the workplace. Because we've just done the biggest working from home experiment in history, and we're going to see what we've learned from that. And some are arguing that managers have learned to trust their people working from home, and this will be a key part of the future. And whilst others in transactional and creative arenas are desperate to get back to the workplace and to get back into a team working environment and to collaboration. It's also a generational thing. Working from home is fine if you've got a proper space to do it in, and can sit in a palatial library like Peter Murray's. It's not so good if you're in a flat share and you've got 2 or 3 of your mates buzzing around who quite probably are in the same industry and work for your competitors, or you're at home with your young children, and that's much more difficult.
We need to move on because we're running out of time.
I've got one sentence. And I was just going to say, I, for one, can't wait to get back into the office and a collaborative environment where we're all working together again. Thank you.
Very good. Thank you, Digby. And well, you commented on my library, but somebody has actually sent in a question saying, is Alex in an aquarium? But so he can answer that when we get to the Q&A. So our next speaker is Yolanda Barnes, and she is chair of the Bartlett Real Estate Institute. Yolanda, over to you.
Well, good morning, everyone. There are so many different things to consider here, but if we start from the point of view of construction, I have deep questions about whether once what we have been building is built, what we seem to be continuing to build in so many places, once it's built, will there be demand for it? And I think the answer to that is very mixed. For certain types of space, and here I include housing as well as commercial space, there will be demand, but I think we have to pay attention to what there is less likely to be demand for. And I think Digby has started to outline those sorts of circumstances. I think one thing that certainly the commuting, the public transport point is very well made. Even though, like Digby, I think many of us have a desire to get back into, well, my dream is a crowded coffee shop and a good, decent flat white. But whether it's the pub or our working environments, you know, we do want to be social, we do want to be together. So I think the question is how much spatial distancing there's going to be and for how long. And that depends on things like vaccines, which are far outside my area of expertise. But assuming that we all are all in future going around with our own personal sort of 2-meter exclusion sort of mentality, and the Brits become even more standoffish than we have been before, then even if we are not experiencing social distancing, we will probably be experiencing some form of spatial distancing. And I think this qualitatively changes our ideas about space. And it changes in many different ways. I think, you know, in the area of housing, the lockdown has really shown us how inadequate certain housing types and environments are, and also how pleasant and good other types are. So, you know, our balconies and gardens have come to be much more highly valued, arguably. Perhaps even conventional streets where you can see your neighbours across the street in their front garden or whatever, or see people moving. So I think there's a qualitative change in the nature of demand. And then yeah, I have real worries in the commercial world about how lettable anything over about 6 floors will be. Who's going to want a high floor to be working in the high floors, say, of Canary Wharf Tower, when the lift capacity, because of spatial distancing, goes down to 2 people per ride? I hate to think what the queues for the lifts will look like. So fit CEOs might still be occupying the 6th floor, but how much higher do they want to go unless they're training for marathons? Staircases clearly into circulation, as Digby said, will have to be changed. I suspect we won't be in the office every day. We will maybe have to be reduced to 1 day a week because of the public transport issues. So it seems to me that a kind of melded a sort of variety of working environments, home, office, and I think most importantly, local satellite hubs. So I have heard of an architectural practice that has actually decided in the lockdown to go completely to virtual working, largely so that their young creative workers can afford the housing markets elsewhere and don't have to come into central London. Others have gone to satellite working, so I think the time has come for the dispersed polycentric city. But I don't think necessarily that the car-reliant out-of-town business parks will necessarily win here, because I think people will want that social interaction at a spatial distance. And so the mixed-use neighbourhood becomes ever more important. And just thinking, it's the contrast between the high-rise sort of intense single-use sort of mixed-use environment of the City of London versus say, Richmond, where you might be able to live, work, play, stay, make, and do all sorts of things in one place. So I think the City of Villages, from that London is very helpful, and I think we have to start thinking about maybe the more outlying centres of London where it is possible to do all these things in place. So, and then I do think that we have to consider, as far as London's concerned, the prospect of a falling population instead of a rising population, and in fact it was only international in migration that was keeping London growing even before the crisis hit. Same with New York. Paris's population was already falling. So I think we've experienced the urban renaissance, the breathing in, the inhalation, as it were, the expansion of London. I think we're now seeing the exhalation, the breathing out, as it were, and it will benefit all the little good places that have already seen growth. The bigger cities like Glasgow, Bristol, Manchester, and so forth, but also the small good cities in not just the southeast, but the Midlands and so forth. So I think there is a kind of a new urban renaissance, or a dispersal, a polycentric sort of urban renaissance to look to, where mixed use, good neighbourhoods really will matter for residents as well as commercial occupiers. And I think it could well spell the end of tall buildings, at least for a short while. And I was interested, Nick said that 28% of sites that have stopped account for 64% of value. Now that would suggest that the stoppages have been particularly high in London, and maybe for good reason. I think that's worth sort of looking into. I think to pick up on Digby's point about investors will be very, very discriminatory about the sort of building that has a future, long-term future, and the sort that doesn't. And so we'll start to see that sort of investment markets almost break in two, renewed demand for new certain types of property that work and have this sort of long-term future, and a much lower demand for those that don't. There's so much that could be said. There's so much that's uncertain, but we are looking at a different market when things return to normal. And I think it's a very, very new and different sort of normal.
Thank you very much, Yolanda. And now our final speaker, before we get on to questions, is Professor Tony Travers, Director of LSE London. Tony.
Hi, well, good morning all. I'm going to pick up one or two points that have been made and sort of consider them a little bit, and then add a couple of other new ones. First, I think we all suffer, and we all do, I mean, I feel this myself, of trying to work out whether everything's going to get back to normal or everything's changed forever. And somewhere in that spectrum, unhelpfully, lies the truth. And there's no question, this is a bigger event to affect London, to affect the United Kingdom, than anything since the Second World War. There have been all manner of things that have affected London since then, and indeed people refer back to the Great Fire and plagues and so on. Well, London recovers from these, but of course it and its economy and its people are changed. So against that backdrop, one or two little bit more detail prompted by what I've heard. I mean, clearly some sectors are doing much better than others and will do in the short to medium term. The Office for Budget Responsibility suggests that the financial and business services sector, the tech sector, lawyers and other professional services probably were better able to work from home. City clearly has got quite a lot of business to do actually as a result of all of this, not least helping lots of governments issue bonds around the world. So those sectors are going to do well, but others, higher education, leisure, hotels, restaurants and so on, in for a very difficult medium-term time. There will be very few foreign visitors to the UK, very little migration for a while, as Yolanda's just touched upon. And therefore, any sector that relied on substantive numbers of migrants or international visitors have got a very rough time coming up. Alex touched on the transport issues. In fact, Digby did as well. It's clear that planning, staggered travel, perhaps much longer opening hours requiring changes to the planning system temporarily will be required. Question, as a sort of sidebar to that, I think there's going to have to be a sort of restart tax package, sort of stamp duty holiday perhaps for parts of the economy, or certainly the construction sector, planning relaxations temporarily. An attempt to kick-start the economy will be required from UK central government, but that will in turn beg all these questions about how people travel, remembering that of course social distancing is the enemy of agglomeration. Everybody's made that point in one way or another, and agglomeration is what generates productivity. And just to reiterate something Alex said, if in the end as a result of this we move back to a more car-borne suburban world, it will certainly be a less economically and environmentally sustainable one. On the question of population, I mean, I'm a bit more optimistic than Yolanda, because although international immigration is going to come clattering to a halt, I suspect for a while net moves from London to the rest of the country will also come to a halt. And of course, London has a relatively young population and has natural growth. So I suspect there will be a levelling off this year, but some growth thereafter. I'm a bit less, I mean, unless we are going to see a radical change in the UK's population and or in settlement populations across the country. Others have touched on this. London is going to feel this very severely, probably central London temporarily rather more than outer London. Outer London may benefit from this, I suspect, and others have made this point that reverse commuting is a way of increasing capacity. It's easier to sustain social distances in lower density areas. You can see how all of that will work. These issues will also affect all the cities we referred to in the past as London's global competitors. New York, Paris, Tokyo, all of them will face exactly these same issues, possibly in an even worse form. Actually, central London is a relatively less dense downtown than almost all of these other places. Curiously, therefore, well placed compared with them. And the point was well made about the need for better space in homes and gardens. London is also unusually by global standards a city of houses with gardens, compared with many other apartment-driven cities. So there are positives in all of this. One final thought, and I'll stop. I mean, it is easy to forget the scale of the hit the UK and other European economies have taken. What's fascinating to me is the way economists, very slowly, every new forecast that comes out is more pessimistic than the previous one. They all started saying, well, it'll be 1 or 2% off GDP this year. The consensus is now somewhere between 7 to 10% of most European economies. And the idea of a V-shaped recovery being replaced by a U-shaped one with an L start. So big increases in unemployment, and I think now a consensus that UK GDP will not get back to 2019 levels till 2023 at the earliest. So more like a depression than a recession. And therefore, my final thought is this: there are all sorts of opportunities in all of this. Recasting retail, not my expertise, is definitely something that was going to have to happen at some point. This is going to speed it up. Question: how do business improvement districts, boroughs, City Hall work in central London and London's high streets to ensure that empty shops don't stay empty for too long?
Great, thank you very much, Tony. And now we actually have got quite a few questions here which have come through. So we've got about 15 minutes left, so let's kick off. So if we can start a question for Nick, and questioner, an anonymous attendee, asks, does your analysis consider small-scale construction projects, including household development, which still impacts upon supply chains and availability of resources and materials?
Yeah, I mean, our analysis is across the board, so it's all types of construction that have been affected. Obviously, some of the data on the larger projects is easier to get. Those are the projects that we're more involved in. But yes, it does cover all types of construction projects. Thanks.
Now, a wider point from Charles Begley. I don't know if you'd like to respond to this one, but it is more positive. Perhaps shouldn't we be shifting the focus to use the opportunity to make cities even more attractive to drive agglomeration by reducing traffic further, creating more space, and finally tackling air quality? The lockdown will only serve to remind people how much they miss and how the sort of benefits we've seen so far might be maintained. And, I mean, it seems a pretty good point. I don't know if anyone wants to comment on that. Yes, Alex. Tony, after that. Alex.
Thanks, Peter. Yeah, I mean, I think Charles is right, and I know that he also I think there was a bit of a call to cheer up for Christ's sake as well in one of his earlier points. And I mean, he is right that, some of the analysis that's being done already by Centre for Cities and others does suggest that London is actually, as we saw in 2008, is probably, it could well turn out that it is more resilient and more capable of dealing with this shock than other places, particularly those locations which are highly dependent on one of the sectors that Tony identified. I mean, Crawley, for example, I know it's a very different scale. Something like 90% of employment is dependent on airport-related services. And we saw after 2008, actually, how London was very, very innovative, if a city can be innovative, at responding to the financial crisis by growing other sectors in the economy. So it may be that London is able to reinvent itself and indeed lead the charge out of this problem. I think in terms of the specific question of transport capacity and so forth, I mean, there's another question.
Brief, Alex, because I've got a lot of questions coming up. So
I was just going, one way you could do that would be to put lots more buses into the system. You know, if you had proper road management, you could have a sort of big, South American style bus system, relatively cheap to and quick to install, to bring forward, but it would require a radical rethink of how we manage road space.
Thanks. Tony, you wanted to...
I'll be brief. I mean, absolutely right. Of course, everything has to be seen as an opportunity. And morning, Charles. But it requires management. So national government, city government, boroughs, bids will all have to think hard about how to do this. So, you know, I touched on the need for temporary tax breaks, Sunday shopping, 24-hour shopping, I don't know, 24-hour opening for some businesses for a while in order to get things going again. That requires somebody to think about it, to suggest it, and the government to respond. And that's, I think, you know, the stage we'll all be moving into next. But it does, so I agree, but it will require management of it by government to deliver it.
Thanks. Now you mentioned local authorities, and so we have another question here. So from Sonia, who says, what can local authorities do to support long-term recovery of the sector? So now we have a very different form of government spending. Are we going to see greater investment in the public sector? Who would like to respond on that one?
Well, I don't want to I mean, the difficulty is the government has found not so much a magic money tree, but the magic money forest. The difficulty is, at the end of all of this, the government's going to end up with £250 billion worth of deficit this year, adding pound for pound to the national debt. So I'm not sure there will be a great deal of money for investment in any sector. But I can see an argument for tax breaks, partly because that's the kind of thing a fair number of the current government's leading members, you know, Liz Truss, for example, but not only she, believe in that sort of incentive-driven recovery. And that would leave the private sector, developers and their supporting industries, to think about which are the most likely to stimulate economic recovery. And going back to something Alex said, you know, the government needs the tax take from the London economy because it's going to have this massive deficit for some years to come. And that is a real problem for the Chancellor, whoever it is, current one and future ones.
Alex. Can we unmute Alex, please?
Yeah, sorry, Peter. I was just going to add one thing very quickly. The government's policy since the election has been obviously the levelling up agenda and to try and get growth going in the less, you know, economically strong parts of the country. If the priority is now to rebuild the public finances, that suggests that the government's approach should be to boost growth in the most productive parts of the economy first, in order to get as much growth at the aggregate level into the system as possible. And that means a much more pro-London set of policies to rebuild the public finances, rather than, you know, the agenda that they've come in on.
Thanks. So Reach Living says, do you think the draft London plan is still relevant in a post-COVID environment? Do we ever got to rewrite it? I know Robert Jenrick wants to rewrite it, but do you think we need to? Yolanda, I mean, you talked about streets and being able to talk across, maybe sing Solo Mio across a street in the future. That's something obviously high on the MHCLG's agenda too, isn't it?
Yes, I think the interesting thing about COVID is that it's highlighting issues. It's kind of acting as a catalyst or an accelerant to trends that were already in play before. And I think one of the questions we would have to face sooner or later is actually whether the current planning use classes, which are actually 20th century investment asset classes, just written into planning law, whether they're actually relevant. I think we've seen such a change in investment sentiment. Alternatives, so-called alternatives, have become the new core in any case, that we were looking at so much money going into completely different types of building. I think, for example, we may well see, I think, and it would be sensible for the government to adopt a move towards turnover-related rents or income-related rents, so we can get over that problem that Digby mentioned of perfectly solvent companies not paying their rent. And certainly, if the public purse is going to subsidise people through this crisis, it has to be related in some way to means, whether it's a company's means or an individual household's means. That if that's the case, then it seems sensible for a lot of investors who are increasingly looking for incomes to pay pensions anyway, to be looking at a different set of criteria, drivers for value. If we're looking at a kind of diluted workforce, a kind of more literally spatially more spread out workforce, that per se then devalues land, because you get less productive units per unit of land. And so I really question whether the old types of planning use class, the investment asset class, are actually still relevant, that we need a more mixed, a sui generis sort of mixed neighbourhood use, as it were, to suit the ways that people wanted to live and work in any case before COVID, and which COVID is going to accelerate. So in short, yes, I think we probably do need to rewrite the plan in a very fundamental way.
Tony?
Well, very briefly, I wouldn't be at all surprised if the government doesn't see what's just happened as an opportunity to have a fairly radical reform of the planning system. I think there's just enough straws in the wind to suggest that this will be used as the opportunity governments for some time have wanted radically to alter planning. We'll see, but I wouldn't be at all surprised if it happened.
Thanks. Now we've had a couple of questions talking about that we've been speaking a lot about social distancing. Will that still be necessary if a vaccine is discovered? Hugh Bullock says, is not the nature and speed of vaccine development the critical factor in determining the future recovery and long-term legacy of COVID? Now, I know you're not scientific advisors, but do you think we don't need to build this into the long-term design of our offices and spaces? Digby, do you think it's going to be a long-term issue for office design? We need to unmute Digby, please.
I was listening to a scientific advisor saying the other day that the chances of finding a cure for the virus that we seem to be working on is that normally you throw darts for the bullseye from 8 feet away. We're trying to identify a vaccine, and that's the equivalent of standing 24 feet away from the dartboard and trying to hit the bullseye in 1. And there are lots of other things that we've been working on vaccines for a very long time and not got them. We can deal with HIV, but we can't prevent it, for example. And I have to say, I think, just my reading of it, personal view, we're a long way away from having a vaccine, and therefore I think the immediate thing is to get comfortable with a working environment in the short, medium term. I think that vaccine point is some way off.
And again, just to add, think about the way we deal with terrorism. We always say terrorism must change the way we work, but it does. We respond to all of these things by then, putting tank tramps along rivers, protective stuff everywhere. We have to queue to get into buildings. So this will affect public policy, whether or not I suspect a vaccine is found.
Thanks. And then we're nearly up to time, but Nick, finally, could somebody's asked a question, is this likely now, from points you're making, to accelerate the adoption of MMC and new methods of construction?
Yes, Peter, I mean, I touched on that at the end of my presentation. I think the way the construction industry is going to get out of this crisis is by innovation, and I think MMC, off-site manufacture, pre-site, off-site fabrication, etc., is going to be what we're going to have to adopt and look at more seriously than perhaps we have so far.
Very good. Thank you very much. Well, I'm sure that innovation is going to be very important, and actually the NLA have been organising various webinars with EY, who are one of our members, about how you can claim all sorts of funds from government for R&D and innovation. So that's a good thing for people to start to try and tackle and get funding from government and from Rishi's money forest. So thank you very much for all those comments, and also thank you all in the audience for your questions. I mean, we at NLA are very keen on the idea that you know, as we return, we can build back better, or as Governor Cuomo said, reimagine rather than just reopen our cities. So hopefully thinking about what the issues are facing at the moment will actually lead us to help produce a better city out of this. Once take the positives, never let a good crisis go to waste, and see if we can create better cities, and also ones that work within the constraints that we have facing us in the, at least in the medium term. So thank you very much to all our speakers, and thank you very much for joining us today.